Hey guys, Scott here, system building course. This video is on working up a volatility breakout system from scratch. Now, one of the things that I realized when I started building the system building course is that working up different types of systems is subtly different. Like there's specific knowledge about trend following systems, mean reversion systems, volatility breakout systems, binary option systems, intraday systems, any sort of system that you can consider. Someone who's been down the road of building a system with that edge probably has some specific information that's going to shortcut your journey. So anyway, what I'm doing is any sort of system that I've had anything to do with before, I'm making a video on how to work up that system from scratch, how to test the edge, how to do back testing, how to work up the exit algorithm, the starting points for what would be a reasonably chosen exit algo, and I'm going to show you how to make all the decisions yourself. So volatility breakouts are an old type of edge that are based on the idea that volatility cycles from low volatility to high volatility. And if you'll see here, this is not cherry-picked price action. You can see this is just today's Euro-US dollar price action. And I've got two measures of volatility up. Measure number one is the ATR, and measure number two is standard deviation, which tightly corresponds to the width of these Bollinger Bands. I've got a 20-period Bollinger Band on here, just for exercise purposes. It doesn't have to be 20, it doesn't have to be anything. A longer term one might actually work better. So anyway, what we are looking for is an extreme of low volatility. You can see here we have an extreme of low volatility, and you can see here we also have an extreme of low volatility. So the things to consider when you're working up a sideways volatility breakout system, you need, number one, you need a sideways consolidation zone. So it doesn't work at all if you're talking about volatility coming down in a trending period. It has to be a sideways zone like this or a sideways zone like that. Okay, the next thing you need is a historically low extreme of volatility. Now, the usual one that people use is ATR is the lowest in 30 bars, 60 bars, or 90 bars, or standard deviation is the lowest in 30 bars, 60 bars, or 90 bars. Okay, then you need a breakout. The ordinary breakout is close above a Bollinger Band, like here, or a close below the Bollinger Band here. Now, you can see in both of these examples, after the first breakout from a consolidation period, volatility has tended to increase, and we've got a tradable move. So here we have very low volatility. It's lower than everything except the previous one. We have a breakout, and we have the market continuing in the direction of that breakout. We can go back and we'll probably find more instances of this. Okay. So here we have a low volatility spike on standard deviation, but not on ATR. We have a breakout, and that breakout continues and continues and continues. So what would you do? Where would you start if you were interested in working up a volatility breakout system? You would start with your own market belief examination paradigm. So you would write down, I like ATR, I like standard deviation, I like Bollinger Bands, I hate Bollinger Bands. You would find the technical analysis that's applicable that you actually believe in, because if you don't believe in it, it's just not going to work, right? Okay, then the next thing you would do is you would pick a couple of different methods of measuring historical low extremes of volatility. And the obvious ones would be standard deviation, average true range, or alternatively, you could do something like the Volstat indicator. Now, what the Volstat indicator does is it puts a very long-term one standard deviation Bollinger over a normalized, adjusted for percent, ATR, and so it's an objective method of saying we're below normal volatility when we're below the purple line, and we're extreme low volatility when we're in these periods. So you're looking for an extreme low volatility, then an uptick in volatility. Now, all three of these methods would be totally fine, and there's other methods that would work too. One excellent method for measuring volatility that I've seen is to measure average candle length over a look-back period, which is subtly and slightly different than ATR, but it tends to make much smoother sine wave curves, much more dependable sine wave curves. And that's something that you could also consider. So, what's the next point? You've chosen a method to test that fits with your market beliefs. You've got some method of examining a sideways consolidation period. Now, how would we measure a sideways consolidation period? One famous method is to go Keltner's inside Bollinger Bands. This is also known as Keltner chart. So an extended period of Bollinger Bands inside Keltner channels, as we can see here and here, and you measure that by the number of bars, like 1, 2, 3, 4, 5. This is a nice objective measure of a volatility squeeze. You can use that in your systems, or alternatively, if you're running a discretionary system, you could say, I just have to recognize the sideways consolidation period. So if the system was more discretionary and less mechanical, you could trust yourself just to recognize this. That wouldn't be a terrible thing for a system. In fact, arguably individuals can recognize patterns much better than algorithms can if they have the knowledge to do it. So if you're an expert trader, this may be something that you could start with, or maybe you could use the Keltner's inside Bollingers, or maybe you could use some other method. You could use a certain number of bars without moving a certain distance. Okay, so what's the next point? We need an entry condition, and the ordinary entry condition for volatility breakout systems is a close outside the Bollinger. So closes outside the Bollinger would be here. Would be here, right? We can go back in time and find more, but this is how you would. This is the most popular method. Now, it's not the only method. You could do a limit. You could do a stop limit order, a certain amount of ATR above the Bollinger. You could do that, but in my opinion, the close above is the best entry, in my opinion, because it shows that there's no mean reversion in play, or that the mean reversion is very limited. It shows that the breakout is real. So I personally would always settle for close outside the Bollinger as my entry there. What's the next step? How do you know you're not fooling yourself? Like, we've got two entries here. How do we know that we're not just like completely bullshitting ourselves? So here's how you do it. You do your scatter plot analysis from here. So you would not choose an initial stop, not work out anything like that, but you would just write down on a spreadsheet the values: entry, profit after period 1, profit after period 2, profit after period 3, profit after period 4, and so on and so on and so on. So let's zoom in a bit. So we've got our entry here. You'd build up a spreadsheet with profit after period 1, profit after period 2, profit after period 3, profit after period 4, like we did on the fake out scatter plot testing. And you can see the rest of the system building course videos where we talk about scatter plot testing, and we're looking for a positive correlation. So we're looking for a line that's pointing from the bottom left to the top right, and we're looking for these dots to be a lot closer together than they are here. Now, you should be able to go through and do 50 or 60 trades and get a decent idea as to whether or not you're fooling yourself. This is just the truth. So that is the first place to see, is there an edge or isn't there? Now, I can tell you that it's most likely that this is an edge because I know many professional traders who are using variance on this in production systems. So I'm reasonably confident it's an edge, but you never just want to take anyone's word for anything. You don't want to take my word for anything. You don't want to take anyone's word for anything. You just want to go through and do the scatter plot analysis. Will it take you the better part of a day? Yeah, it will. You know what? And can it be automated? Yeah, it can be automated with Quantopian or something like that. If you're a programmer, it's very easy to automate. But personally, I would not automate this process. You get a real feel for being down in the weeds if you take the time to go through every trade, every spreadsheet yourself, go back. Okay, now, what extra things can we do to increase the confidence in calling it an edge? We can try it on different markets. We can try it in different time frames. If something works across the board, it is far more likely to be real and robust than it is to be curve fitting. If you find something that only works on one market and you think, I've got this great gold system, but it could be real, like there are systems like that, but those systems tend to be highly optimized. A system that only works on one market tends to work really good for a long time and then fall apart and never work again. So if you're going to do those sorts of systems, you need to have a regime in place to turn your system off when it stops working. Okay, what's the next step? How do we build an exit algo out of that, assuming that we found we have a positive correlation? So assuming we found a positive correlation, which means that after our entry condition is met, we have a statistical tendency for price to keep going in the direction of the breakout. Once we've proven that hypothesis, and we should be trying very hard to disprove that hypothesis. Okay, we should really be trying very hard to disprove that hypothesis. Then we go to what's called an Mfe analysis. So I want to show you a max favorable excursion analysis I did for a different system. I just got mine in there. So Mfe is maximum favorable excursion in R. So I've chosen an initial stop, and I've said how many multiples of that initial stop to the entry point did the trade go before it reversed. And I'm being sensible here because, for example, let's say a trade like this one made 2.6 R and then completely reversed and gave it all back, and then went up to 10 R. It's still a 2.6 R retracement because no sensible trader would hold through that retracement. So here, this one made 1.3 R and then reversed. This one made 1.5 R, retraced 1 R back to 0.5 R, then made 4 R. So I can still call that a 4.5. This one made 4.4 R, retraced 1.5 R, then went all the way to 6 R. So that is a reasonably, you could reasonably attempt to hold for that. So this is a small sample size. It's not enough to make any real conclusions, but it's a demonstration of how you go about the process. So we generate this histogram of the maximum favorable excursion of winning trades. You exclude the losers, you only want the winners, and nearly all the time you're going to see something like this. You're going to see a flat spot. Sometimes you see more than one flat spot. You're going to see a flat spot here, and this flat spot here is the bare minimum that a winning trade kind of makes. And you can see here that if you took some profit at 1.5 R, you would catch all of those, right? Okay, if you took some profit at 1.5 R, you would be reducing how much you would get on the 6 R and the 5 R and da, 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 da. So one of the things that you should do then is work out if you need to be taking partial profit. So the first thing to decide would be, do I want to bank any partial profits? Now, your decision to bank partial profits is influenced by how many open trades you have at any one time. if you have, even though it might be statistically optimal to say hold for a 4R win or trail a stop at 3R, if you have 10 trades open at once, eventually all 10 of those trades will reverse on a big bad day or some bad news or some out of the blue change of market direction. And so all of those 10 trades that have a 60% chance of winning that should never all lose together will lose together. And so what you're trying to do when you have a lot of open trades as part of a system is to reduce the standard deviation by banking some early profits. It's a very good way to reduce drawdowns. So the next step is to plug in some different limit exits. Now, limit exits are a suboptimal exit. They're never going to be as good as a properly crafted exit algorithm, but they give you an idea as to whether or not you're barking up the wrong tree or not. So what we've got is total R at different limit exit. We've got a limit exit at 1, gives us almost no R. A limit exit at 1.2 gives us 13R. Limit exit at 1.4 gives us a bit less. 1.5 gives us 12R. 2R gives us 14. 2.5R gives us 17. 3R gives us 15. And 3.4 gives us 3.5 gives us 17R. And 4R gives us 16R. So obviously what we're looking for is we're looking for not one number by itself. We're looking for a decent number in a forest of decent numbers. So around here we can see that the forest of decent numbers is going to be, we're going for an actual, we're going to get the best total R if we're going for a best case winning trade of between 2.5 and 3.5R. So now we've got some clear guidance that we're probably going to be optimized as long as we go for 2.5 to 3.5R. So what might we do? We might bank some partial profits. We could institute chandelier stops or parabolic SAR stops, or we could tighten stops as we get up past 2.5R. You could institute a trailing spike low stop at 2.5R to try and capture a big move, but minimize the extent of retracements after that. So you need to look at the system building course video on exit algorithms, and we give you a bunch of different options, and you can slot in, you can cut and paste, you can test to your heart's content different exit values. But very clearly that what I would say is that any reasonably chosen exit algo that's not nonsensical should be something in the ballpark of the right number. So as long as you're not being stupid, it should really affect drawdowns more than top line R. So exiting at 2.5R is just a ridiculously stupid exit, and yet it makes the most money out of other exits here. So that's the type of thing that you want to be looking at. Okay. So we've tested with a scatter plot our entry. We've done an Mfe analysis. How many trades do you need to do? 50 to 100 is a good start for an Mfe analysis. It's not statistically valid, but it's enough to give you some data to work with. At that point, what do you do? At that point, I always drop back to a daily time frame to see if my results are improved by taking setups on a daily time frame. Now, one very good way to test this might be to run this on individual stocks and run it on a daily time frame. I would strongly suspect that this is probably going to be a much better way of running this than on an FX basis. So I have a friend who runs this type of system, and I can show you his results. So let me find the results for So my friend has taken 141 long trades and 195 short trades. Candidates in his universe. He's got 57 long entries and 71 short entries in a year. he has 31 losing trades and 19 winning trades long, and 48 losing trades, 21 winning trades. So on the whole of it, he's looking at 54% on the long side. 33% win trades on the long side and 30% on the short side. So the short side is a negative edge, and that's something you really quite commonly find in stocks. In a bull market, obviously, anything short is going to be a negative edge. So it's not curve fitting if you're trading a stock market an individual stock system in a bull market to just not trade the short side, and it's not intellectually dishonest to do that, because the long and the short side behave completely differently in stock markets. They're like really very different animals. And I know there's people who believe that the short side is just a long chart turned upside down. That's wrong. It's demonstrably wrong. Okay, and the reason I know it's wrong is I've tested it, but also the vast majority of trend following CTAs running hundreds of billions of dollars, they completely switch off the short side of equities, and a lot of them don't trade the short side at all. Okay, so his expectancy per trade on the long side, even with 33% win rate, his wins are so much bigger than his losers that he's got an expectancy of 1.0 per trade, which is 5 times the benchmark for a minimum tradable system. Okay, he's got an SQN of 2.4, above 2 is very tradable, so this is excellent, and he's made 53.4 R in a week, 53.4% for the year, or R, trading at 1%, which is normal, and he's making an average of 3.8% a week. Excuse me, I'm kind of sick today. So those are the sort of results that are possible to be achieved with a well-crafted system. Now, this is not a completed system. If you want to take a closer look at my friend's system, you have to buy the system building course. But what it is a step-by-step process on how to work up a system from scratch from an idea. Okay, I hope you enjoyed it.